Hey everyone, Credit Shifu here, and today we are going to be talking about a little trick that could save you over $1,000 on your tax bill. And it is tax season, so that's why we're talking about this. Now, if you thought that your tax bill was based solely on your behavior last year, your income and your deductions from 2017, for the most part you'd be right, but there are a few things you can do now before the tax deadline on April 15th that can save you a lot of money. And the one we're going to look at today is IRA contributions. Now, an IRA is a retirement account outside of your employer's 401k. It's not, done by your employer, it's a personal one, and they come in two types, traditional IRA and Roth IRA. So with a traditional IRA, any money that you put into it now is tax deductible. You do not have to pay income tax, federal income tax on that money, okay? With a Roth IRA, it's the opposite. The money is taxed now, you put it in, and in the future, 30, 40 years down the line when you take it out, it is tax-free. Now with the Roth IRA, obviously you would save more money in the long run because it's going to grow because it's an investment account. When you take it out, it's tax-free in the future. But we're talking about saving money now on your current taxes. So today we are going to be talking about the traditional IRA. Now let's talk about a few terms and conditions first. So the tax deduction on the IRA is only available if you are not paying into a plan with your employer. But if you earn for single filers under $62,000 per year, or for joint filers under $99,000 per year, you can have both an employer's retirement plan and also enjoy the tax deductions on your IRA. With IRAs, you can contribute up to $5,500 per year tax-free, and if you're over 50 years old, you get an extra $1,000 in the allowance, so $6,500 per year that you can put in tax-free, okay, and have a tax deduction for. Now, the money you'll save on your taxes is worked out from your highest tax bracket. So let's say the highest rate at which you pay tax is 25%. It's 25% of each $100 or each $1,000 that you put in to your IRA. So for a very simple example, you put in $1,000, you will pay $250 less tax or get $250 tax rebate depending on your situation. Okay, so if you put in the maximum of $5,500, you stand to save $1,375. Obviously, it's going to be even more if you're in a higher tax bracket, but we're just looking at the basic 25% tax bracket. Okay, so that's people on sort of regular incomes. We're talking average household income, 50,000 and above. But if you are on lower incomes, particularly down sort of in the 30s, married filing together, but income is sort of in the mid 30s, whatever, you stand to save a lot more. And I'll tell you how. So there's something called the Retirement Savings Contributor Credit. And to be eligible for this, you have to be over 18. You can't be a full-time student, and you can't be claimed as a dependent on someone else's tax return. And what this credit does is it refunds either 10, 20, or 50% of the money you put in to your IRA up to $2,000. And there's different brackets, obviously, income levels, and that determines how much of a refund that you will get, okay? So to get the full 50%, if you are married filing jointly, you have to be earning less than $37,000 per year. And at that level, if you put in $2,000, you will get $1,000 back, okay? $1,000 either reduced from your taxes, or if your taxes already are paid because you've been having deductions from directly withdrawn by your employer and you don't owe any taxes, that $1,000 will just be refunded to you, just given to you. So that's amazing. And if you put in 2,000, you get 1,000 back, you're getting a half price IRA. And guys, I'm just putting it up on screen now. There's the graph that shows sort of the income levels and the marital statuses, how much you can get. If your income is a bit higher than, you're in the 40,000s, you can actually still get a 10% or 20 or 10%, refund depending on your income level and stuff. So it is worth checking out. There definitely will be a lot of people who will fit into this category. I'll put the links to articles on the IRS website about this in the description of this video. And then also, if you're in that lower income range, so sort of mid-30s and below, and particularly if you have children, there's something called the Earned Income Tax Credit. It's up to, so if you have one child, it's up to $3,400 per year will be deducted from your taxes, or if you haven't paid $3,400 in taxes, it'll pay your taxes for you, and then whatever is left over will be refunded to you. So this is another refundable credit, all right? If you owe zero tax, you just get given $3,400 if you are at the level where you qualify for the maximum. So I'll put a chart on screen now that shows, this is actually from 2014, so the income levels have changed a little bit, but you just get an idea of how it's worked out. As your income gets lower, the amount of the credit that you receive goes up, okay? So by contributing to an IRA, you are lowering the overall amount of taxable income that you have, and this will raise your earned income tax credit. So for people in the lower income range, you stand to get much more savings than people in the higher income range. You could get a 50% credit, you could get the regular deduction, maybe 15 or 18% or whatever tax bracket you're in, plus you're increasing your earned income tax credit because you have lower taxable income. So all these things combined, it's very complicated. I'm not a tax professional. I'll put the articles about it down in the description. If you use a tax service like any of those tax software or an online service like Credit Karma, it's very simple. If you enter your IRA contributions into the software or the Credit Karma tax website, that's the one I'm using this year, it will automatically work out all these things, like how much your earned income tax credit should be, if you qualify for the retirement savings contribution credit, and if so, how much, whether you're in 10%, 20%, or 50%, it'll automatically calculate that stuff and you'll see how much refund or how much your tax bill has been reduced by. If you already have some sort of savings account, right, and so you already have that money, it's not money that you really need, it's just a no-brainer that move a couple of thousand into an IRA, or if you have, say, 10, 20,000 saved up that you're, trying to save long term, move 5,500 into an IRA. That's the maximum you can do. And if you're a first-time home buyer, don't forget you can still take out $10,000 without a penalty sometime in the future after that money has grown. So really, guys, it is a no-brainer. It is very complicated, so I'll put all the articles from the IRS and all the, stuff that you need to know about it down below. My description of the last few parts of it may not have been totally 100% accurate because obviously I'm not a tax professional, but you can read all this stuff for yourself. You really will be able to save a lot of money, I guarantee it, if you're willing to put away, a few $1,000s of savings that you perhaps already have. All right, guys, so let me know what you think. Don't forget you have until, I believe it's April 17th, so actually a couple of days after the tax deadline to contribute to your IRA if you want to claim this. Let me know what you think in the comments below. Please subscribe, and we will see you next time with more credit card and personal finance tips and tricks. Bye-bye.